Well, hello everybody. It's wonderful to see you all here on this Wednesday evening. I hope you're all in good form despite whatever's happened in the week to date with markets or hasn't happened. If you just let me know you can hear and see things okay, that will be sensational and we'll get things kicked off. Good evening, Adrian. Thanks, Walter. Cheers, Alison. All good. Yes, all is good my end. Thanks. G'day, James. Perfect. Hi, John. Good to hear all is sweet in Bali. I'm imagining it's often the case. G'day, Rachel. Okay, so let's kick off with this important message, of course. We are talking accumulating into positions. We are looking at live markets. So, of course, you've got to bear in mind these are my opinions and my experiences, and hence opinions are my own, shouldn't be taken as a representative of Go Markets. And of course, because we're having a look at live markets, just remember that this is for educational purposes only, not direct trading advice to take or direct advice to take any trading action. It is a system that we're talking about today. So of course, the ultimate choice rests with you in terms of how much you embrace this as a potential and follow through. So that is that important message cleared. Let's get into, g'day Russell. Let's get into what's going on in the markets at the moment. Well, a few things going on in the news. Obviously, we've had a softer day in the US yesterday. Really, the market smacks of caution. The reason for this is obvious. First of all, there's been no earth-shattering news over the last few days at all, really, to move markets. Very little economic data that's come out. No new news on COVID, really. Of course, still potential concerns in Europe. So really nothing for the market to grab onto and run with. So there's been a lot of repositioning going on and a lot of caution ahead of what's coming up in the next couple of days. Big data day today. And we've just seen UK GDP come in stronger than expected. We've got more big data coming out later, of course, with the ADP jobs report. Now that's interesting and will be really looked at carefully. It's often a precursor to the monthly jobs report out of the US, which comes out on Friday morning. But of course, stock markets are shut. Bond markets will still be open on Friday morning, and FX markets on in the US, but it'll be a shortened day. So the response in equities will be zero on Friday. So I'm expecting some fairly major response to the ADP jobs number tonight. On top of that, just in case there wasn't enough to be concerned about, there is US earnings season starting, I think, the week, in a couple of weeks' time. We are at the end of quarter as well, which creates some interesting price moves. And those of you who logged into the magnetic session last week will have had a good result if you followed through on the ASX trade. We'll briefly have a look at that, but if you missed that, then pop me a little line about the end of quarter trade. They've got about 7 different strategies they use, and that one worked really well today. Again, so really, and then we've got the US dollar index keep on going up. Bond yields are probably the major market headwind, whereas the tailwinds are those other things that we talked about. The economic data potentially coming in more positive than expectations, which it appears to be doing right now. So we'll have a look at all of that. I'll meander around by looking at the futures, which have been flat all day, absolutely gone nowhere. Okay, I've not seen a day like this for a little while. We can see the US dollar's dropped off a little bit, strengthening the GB pound. A lot of that has been recent, and weakness in the yen. The yen is not in a good place again. Some strength in the commodity-based currencies. Gold and silver miserable technically, and oil's holding its own. You can see the US Treasury futures are pretty flat as well. So Nothing going on with treasury yields, and copper's moved up again, which has helped commodity stocks today. Here's the economic calendar. Give it a bit of a refresh. Come on. So if we look at what's gone on, then we had some Chinese data come out this morning, which is better than expected, the PMI data, which was good. And now we're moving into obviously the European session. So we've seen, where's the GBP number? The GB pound number. Let's put today up, okay? So you can get the whole thing. So there was the PMI number. We expected a bit of a market response. The only market response we got was strength in commodity-based currencies on the back of that. Despite those housing starts being better in Japan. Anybody else getting sound issues at all? Let me know. If you can hear me, type in the box, please. Okay, all good. Must be a local issue. Let me just send a message to this chap. There we go. I just sent him a message. Okay, thanks for that, guys. But you can see that GDP number in the UK came in far, far better than expected, or 0.3 better, which is quite a chunk in terms of GDP. And not only beat expectations, but last week's number as well. Same with the year-on-year figure. And we've got business investment better than expected as well. Now we go into the European session. Unemployment change is better than expected in Germany. We're seeing CPI data, which is really important in the Eurozone. We're not seeing any inflation there at all. We didn't expect to, but that's going to help dampen down the inflation fears, which may have a positive effect on bond yields. Ultimately, though, indirectly. And of course, we've got two key things coming out today. As I said, we've got the ADP employment change number and the pending home sales. If we move into tomorrow, we've got some massive stuff going on. Again, we've got PMI data coming in across the board. We've got the weekly jobs number. So it's going to be another big day tomorrow. So as I said, this next 2 days are pretty crucial. And yeah, so let's have a look at what this all means in terms of charts. We'll start with the US 500. So for context, we'll put on the daily chart. You can see there we're pretty neutral today. There's a neutral candle, not gone anywhere. We'll have a quick look at the 15-minute chart. You can see, let's look at an hourly chart. It's probably better. So there was Asian open, and really we've traded within a very, very tight range the entire day, ever since open. But you can see all we've done really is tested those record highs, come down a little yesterday, as we said, neutral today. Same across the board. Now, if we look in the currency market, let's start with the US dollar index. Big session yesterday. Again, consolidating its position over that 200 MA. Now, two currencies were hit hard. We had the US yen and the euro, both of which, of course, are major components, whereas the commodity-based currencies did okay. So if we, first of all, look at gold and silver, here's silver smashed through that 200 MA, trying to claw its way back to it, around about $24. We did talk about this in yesterday's live update session. And of course, gold is looking pretty miserable too. We're testing to the downside that support that we hit earlier in the month at 1680. So that's good to hear, G, that you're back with us from an audio point of view. Looking at some of the currency pairs, let's just kick things off with the Euro USD. So you can see there on the daily chart, it's looking miserable, continues to do so. Just take this back a little bit. You can see we are at a key level here that we're trying to hold on to at 117.42. Potential, if we break through this, to move down to that next level, which is around about 100 pips away at 116.38. So really a critical point, but today's later action has seen us move. We look at the 30-minute chart, seeing a nice bounce back up to that level to test it, which we're at now. So there was a breakout trade earlier on today, if you were brave enough to take it on, but there were probably better opportunities than that. If we look at the US yen, which shot out of the traps like some trading greyhound. So this was Asia for the first couple of hours, and then boom. But we've given off a lot of that back, interestingly, and that possibly is just a little bit of realignment, a little bit of end of quarter stuff, and of course the commodity-based currencies are looking good. Let's just look at that ASX trade. So this was the end of month trade that, the end of quarter trade that the boys talked about last week for magnetic. There it was in all its glory. So this was the last hour of trading. So on, let's put it on the 15-minute chart, actually. There we go. So there it was. Okay, so what's that, 68 points of caught. So the end of quarter trade caught, I must admit, it caught me out in terms of some of the stock positions I was in. None of them were stopped out, but it just made things look a little less favorable than they were already. But you can see since then it's really sort of traded again within a tight range. But there is some justification for that trade that they put up, which was sort of very interesting indeed. If we look at if we look at Aussie yen, we'll look at the daily chart first of all for context. There's the key level, 84.17 as support. Been in this a couple of times today. So there was Asian trading, popped up high, had a little bit of pullback, then popped up high again. So a couple of trades there that were useful from the short term, if you trade them on the very short term. But now you can see we're trading within a range now between 84.17 to the downside and about 84.28 to the upside. So flatlining a little bit on that now. We'll look at some of the movers and groovers. Just a couple of quick share trades are the ones that were the highlights this morning. Zero, we've been banging on about this for ages. Let's just pop it on a daily chart. You can see why. So we're accumulating into this, which we'll talk about in a moment. So we're looking for next level is above that closing high there. That should take us up to around about 132. We also like the look of some of the resource stocks, but they sold off towards the end. Seek were probably one of the outperformers of the day, and really nice candle to the upside to follow through on that breakthrough of the 200 MA. So just a couple there of interest. Okay, so we can have a look at anything you want to later on. Just we'll create some space to do that, but I really want to get into the educational component of it. So we're really waiting to summarize all of this up. Markets a little bit cautious, a little bit concerned about what to do. We're waiting for some data to come out later on today and tonight to reinforce that idea of economic recovery. There's two things that could happen. A, that suggests the economy is going to, markets will see that and think, oh yeah, the economy is going great. That's going to be more likely to result in earlier interest rates, and some bond yields will rise, so equities will struggle, or there'll be an acceptance that bond yields are where they are, and the equity markets will go up on the back of that. And again, we're making some repositioning into the weekend, and it'll all break loose on about the 14th or thereabouts when the banks start to report earnings. Let me see what Alison's written. GB pound at JPY. I've been tracking this, and we'll talk about this in a moment. It's interesting. I'll explain why there's that chart, but here's the minute chart on that. Again, This is one I'm in at the moment, actually. So it didn't get stopped out there, but it's going again. So this is the minute chart, which is a bit radical. Let's not do that. So this was the GDP number, shot it up again, and really testing that sort of high there. So I would agree. We're at a key point here right now. If we look at the 15-minute chart, if we look at the 30-minute chart, if we look at the hourly chart, all showing higher. So it depends where this closes at those various points, and it's an interesting one. So you can, it's an interesting one. Just remember this for later on. So if we look at, let's put the daily chart on. Obviously, the daily chart says we're broken through that. Okay. Whoops. But obviously we're not complete on the day yet. Okay, I'll just change that color from a blue if that's okay, because otherwise they're all going to be blue and it's going to be irritating as. Let's change it to Navajo white. There we go. That's very visible. Okay, so you can see that key level at 150.180. We're through that. We're trading towards the top of the session. On the hourly chart, we're at a high. We're trying to break that pivot high from that last candle. On a 15-minute chart, you can see exactly the same. So whichever time frame you look at, we're looking towards a breakout. Depending on what happens with the next move, the next bit of price action is going to be key. Okay, so thanks for pointing that out, Alison. We'll be coming back to the GB pound yen in a moment. Okay, good call. Let's see what the VIX is doing for sure. VIX is trading towards a nice little bottom there that we haven't seen for some considerable time. In fact, and not on this on the data that's available on the MT5 platform. It's at its low, but obviously that's only a fraction of the data that's available. But it's at in fact maybe even a little bit below its historical average, just to put that into context. So that's where the market is. So expect some movement over the next couple of hours, and there are some breakouts there. You can see the market's responding to some of the data that's coming across slightly better than expected. So on to the topic of the day. So now, some of you will have heard me talk about accumulating before at a relatively basic level, but what I thought I'd do is give a bit more meat around those bones, and secondly, give you some further thinking on the topic. Okay, so when we're talking about position accumulation, we're talking about, it doesn't matter, we're talking currencies or stocks or whatever, it's to increase exposure to a particular asset by buying a second or even subsequent positions in the same trading direction. Now, a couple of key things right from the get-go. The underlying principle of accumulation is only to add to a profitable position. The alternative is to add to a losing position. That's called averaging down, and this has some relationships to dollar cost averaging, but averaging down is really a I'll explain what it means. Let's say you bought, let's use simple figures. So let's say you bought a stock at $10 and it dropped to $6. Then you could buy some more at $6, and it means your average cost into that trade would be $8, or into the two trades, and then it dropped to $5, and then you buy some more, and then you'd average all of those out, and it would drop your overall average entry price in the hope that it eventually goes up again. Now, I've never seen this work, unless you're Warren Buffett, in which case you've got billions of dollars in your very deep pockets to be able to manage a major market move to the downside. So if you have, all well and good. If you haven't, don't do it. Okay, it's really that simple. So accumulating is all about adding to a profitable position. Now that can be long or short, but nevertheless it's still profitable. So it's continuing to move in your desired direction. And obviously, as with any system or part thereof, an accumulation strategy should be articulated within your trading plan, or you're destined for it not to work. Okay. Now, again, recognizing that some of you are new, then I'll just give you some background on this. Some of you may or may not have heard of the turtles, the trading turtles as they were so called. And in 1983, there were two commodity traders in the US, one called Richard Dennis and the other William Eckhart. And Dennis believed that traders could be made, whereas Eckhart believed that there was something inherent in a character, in a person's character, which meant they would become good traders. So it was a typical, or it was a traditional nature versus nurture experiment. And so what they did is they put the advert that you can see on there, which I found something I was able to snip. They put an ad in the Wall Street Journal. And what they did is they primarily traded commodity futures, although there was some Forex pairs in there as well. And they were hugely successful. So they had a recruitment process, which was a true and false. They went through a number of questions, which nobody actually knows what they were. There's a couple of good books. There's one by a guy called Curtis, if you want some info. But there's lots of info on the web. Some of it's good, some of it's really bad. There's one of the Asian educators, when I was doing a bit of research on this, just to see if there was anything current, was suggesting that he'd done a back test of, or he'd done it. It might have worked in the 80s, but it doesn't work now, which of course is fine if you replicated what they were doing, but he didn't. So he wears the galah hat of the day. So just to talk about the rules quite simply. G'day, Stephen. Great to see you here, mate. Absolutely. So what they were doing is it was purely mechanical. And these are very simplified version of the rules, just to give you a feel. So what it was totally on price action, which you guys who have developed TAs will empathize with to a large degree. So essentially, when the price breaks above the 20-day high, then it's an entry. Okay. And the stop loss was 2 ATR from the entry price. Essentially, the N is the volatility of that daily chart, okay, which we measure these days with an ATR. So 2 times N equals 2 times ATR, okay? And then they did it, the trailing stop was the 10-day low, okay? So this obviously moved as the underlying asset moved. There is 2% per trade of the account size, and they accumulated at every half N, okay? So every half an ATR, essentially, they accumulated another position. So, and then they had a maximum position level specified, okay? So I think it was 5N, but I didn't have quite enough time just to check that out. But from memory, it's 5N. So essentially, you've got an entry criteria, you've got a stop criteria, you've got a trail stop criteria, you've got a risk management number, you've got an accumulation strategy, and you've got a maximum position that you're going to hold. So that was it. That was it in essence. Now, there are a lot more details to that, but essentially it was based on the idea of trading with the trend is the way to go. And secondly, as well as price action volatility, as in measured by N, is something that is worth considering in your trading decisions. And some of these absolutely whacked it, and many of them became fund managers later on. So there's the turtle. So from that, of course, I've been sort of touting this sort of approach to accumulating is, first of all, as I've already said, you need to only do this into a profitable position, never add to a losing position. And of course, specify the circumstances that you're going to consider. So that's really the when, the how, and the what, okay? And there are 2 ways people tend to use this. So they'll accumulate if they've chosen to enter a smaller position initially, because perhaps the signal wasn't quite as strong, or market conditions, there was a little more risk there. So let's say you entered some 0 today on the ASX, with some underlying risk because it was the end of the quarter, and of course because of some major data coming at market. It's going to be closed on Friday, long weekend, or etc. etc. So you enter a small position, and then once the weekend's done and all that's out of the way, then you can enter another position if it's still looking okay. Or you'd quite simply entering a position with a normal position size and then increase momentum in that. Bottom line is, you need to be able to technically justify any accumulation, and really, really, really important is all accumulated positions should be viewed as one trade in relation to exit. Okay, so this is the basic system. So if you enter, let's say you enter 0.5 minute lot, 0.5 minute lot, 0.5 minute lot in 3 separate places on a chart, then your exit is going to be the same for all of those altogether. So you're trailing your stop to make sure that your latest position is within your maximum tolerable risk. Okay, be it 1% or 2% or whatever it is for you. Okay, so this is what a system could look like. So what I put forward is a simple system to get things started. If you haven't accumulated before, this is where to kick off. So no accumulation larger than that initial position. So it's 5 minute lots in an original position, then a maximum of an additional 5 lots per accumulation point. Of course, you need to watch your margin usage. Now, there's nothing stopping you entering 3 minute lots of an FX position. If you're trading shares, it could be a specific number of shares. If you're trading CFDs on the indices or the commodities, it will be a set number of contracts or partial contracts. And then you have a technical signal for accumulation. So, for example, and the one I'm going to show you in a moment is a breakthrough key price point. So it could be a resistance or a fib level, or a continuation of trend after a pause or retracement. And then there's other things you can take into account. And here's an interesting point. Just write this down because it's not on here. Really, you almost view an accumulation is, would I get into this position as a new trade if I wasn't in it already? Okay, so there's a good yardstick for that. And as I said, you've got an initial stop on your original position and it's trailed on all your accumulations, and you continue to trail it even if you're no longer accumulating. Within your plan, you should specify a maximum position to be taken. So you start off, perhaps you should say, maybe with FX, maybe 2 standard lots is your maximum. Maybe with, or if you're trading smaller accounts, maybe 0.8 standard lots or 1 standard lot, whatever it is for you. Likewise, of course, you do exactly the same for shares. Although with shares, you may do it on accumulation, or sorry, you may do your maximum exposure value is one way to look at it, perhaps. And then, of course, you've got your other profit take and exit strategies kicking around there, like profit targets and what you're going to do with economic data and all that sort of stuff. So that's your basic system. Now, just to show you, we just talked about JPY yen. So this was 25th of March. There you go, that's relatively current. Okay, so we've got a double bottom formation going on here. Okay, and we've got an entry of a mini lot at 149.63, and we've got a stop at 149.20, 43 pips down. Now we've just done this on basically, if it comes down to here, then that's our trading idea gone wrong. So we're risking $258 on this because the conversion for GB pound, Japanese yen is around about 6 Aussie dollars per. It's not 6 Aussie dollars per pip, it's 12 Aussie dollars per pip, but we're obviously trading half a lot. Okay, so it's 6. Okay, so that was our initial entry. Excuse me. Okay, so to cut a long story short, which is always a good thing, here was our initial stop. So we accumulated at that point there on a breakthrough of there, and we trail our stop up to this point here. So this point here, our stop on our first position is break even. So our risk is just the difference between, on this trade is just the difference between this point here at 150.04 and this stop at 149.63. We accumulated another 0.5 lots at that point there on a breakthrough of this trade. You can see there we've trailed the stop at the same time, so the stop is now at 150.04. So again, 44 pips is our maximum risk to that last position. The first one's in profit, and that's locked in with that trail. The second one is at break even. We'll move on to our third accumulation, so our fourth position in this, and we can see we did that on another breakout. Trailed the stop again. That's hit our maximum two standard lots of trade. If we're accumulating, and so there was no accumulation once it broke this level here, and so the stop was trailed up to this point here at 150.96, which is a 39 pip risk from its high of that candle there, and ultimately, of course, this was triggered, as was this triggered in profit, this triggered in profit, and this triggered in profit. Okay, so what all that meant is this. So our initial trade, and if we just bought a position and subsequently trailed it up, as we've talked about many, many times before, then we would have made $888 out of this trade. Okay. Then, of course, on top of that, we've got 107 pips with our accumulation 1. So that netted 642, 53 pips with accumulation 2, and 17 pips with accumulation 3. So that all added up to 1950 profit. So you can see the difference in accumulating is in excess of 100% from if we just held the position initially. And all of this was simply achieved by trailing every position at the same time. Now, if we accumulated on position 4 rather than just trailed it, sorry, if we'd done and yet another accumulation, if we didn't have that cap of 2 standard lots, then, and we'd accumulated at this point, then we would have lost 174 on that last accumulation. Okay, so it would have dropped it to 178 something. Okay, so you can see how that went. Now, since then, of course, it's decided to go on again, but what can we do? Well, this trade's gone, so we can start all over again if we want. In fact, Alison pointed it out. This is, look, so there is our, right, if we just pop this on the hourly chart, there you go, you'll see it in all its glory. Oh, let's knock that off. There we go. So that was exactly what you've seen there. Of course, since then, it bounced up and down a little bit, but we could have, if we'd been in a 4-hourly position, 4-hourly chart, this would potentially have still been okay. Or we've been, obviously we would be doing this at different points. So let's just get some of these lines out of the way. So we might have maybe accumulated at that point. We could have accumulated at this point here, with there being a breakout. So there's a trend pause and a break. And our stop would have been there underneath that retracement. We could have then entered some more at this point here. Okay, and our stop would have been moved up to this point here. And then, of course, we'd be game on. We might have even accumulated some more at this point here. So it depends on the time frame as to how choppy it's going to be and how likely you're going to be out of it. But of course, 4 hours is 4 hours, 1 hour is 1 hour. You've got some choices to make. And of course, that's what it's done now. So that is still looking pretty much like a breakout on the 4 hour, pretty much like a breakout on the hourly, most certainly a breakout on the shorter time frames. So sayonara, whatever the term is. So it's looking pretty hot to trot, as we've just in the last, well, since we've come onto the webinars, in fact. So that's all good. So if we look at the Aussie yen on the 5 minute, it's not actually doing very much, trading within a range. So no need to accumulate on this one yet. But if it does break that, this might be, so what we might do with this is we might enter it at, let's say, 84.30. We could accumulate if it breaks 84.35. Now this is very tight because it's on a 5-minute chart. Wouldn't recommend you do it on 5-minute charts, but just want to give you an example. Look at the 30-minute chart, it's possibly a better one to do it on. And you can see how that's blue sky again. It's looking at. The yen is just so miserable. In GB pound, letting it run, maybe I should accumulate. Well, look, ask yourself that question. Remember the bottom line question I asked, or I suggested you asked. If I wasn't in this trade already, would I enter a trade in this position? And if it fits all your criteria for a breakout trade, for example, then maybe the answer is yes. But just remember to trail everything together. Okay, so that's the basic strategy. So what's next then? Well, perhaps there's a few things you can look at once you've mastered the basics. And I know, and again, some of you will want to translate this, give it a shot on your EAs as well. So here's some things to think about. So the key questions with any accumulation strategies, once you've mastered the basics, you're convinced that there's something in this and you want to refine it a little further, or is to look at what signals, to look at when you're going to do it, to look at how you position your trail stops and how many you're going to enter. Okay, so we're going to go through each of those in turn, just to give you some things to think about. And I'll tell you what my thinking is. Now, bear in mind, this is, what I tend to do on these sessions is if I have a new trading idea, I'll bang it on out there, okay? I'll put it out into the public domain as a consideration, put the logic behind it. So this is not tested to any significant degree, although I've got some evidence to suggest some things may be worth having a look at. So now, with the example I gave, if we look at the signal first of all for an accumulation, a signal is a key price level. Okay, so that could be, if you're manually doing this, if you're discretionary trading, then that could be something you do, and you can pre-plan this. So if we look, for example, at, let's say, let's use an example we talked about before. Actually, let's use Qantas because that's an interesting baby. So Qantas looks as though they could be reversing, okay? So our initial entry on this could be if it breaks, could be you were caught today, of course. Not pointing at anybody in particular, Mike, but could be a break of 512, okay? So that may be our initial entry. But we could enter maybe sort of, let's say we're going to enter a couple of thousand there. And then our next key point is this one here. So there's our next key level. So we put a pending order to get filled at 515 perhaps, and then another pending order get filled at 527, or with stops in, of course, and then we can alter those as we go. Then we might accumulate again if it breaks this level, and might accumulate again if it breaks this level. And of course, if it doesn't break those levels, it comes back all the time. We've got to stop. So all the time we're accumulating. Let's say our initial stop is below our $5 that we keep on banging on about as a key level for Qantas. So let's say this is our stop here. Okay, so once it moves up to here, then of course we're trailing up to break even. Once it moves to this, we're trailing up to this. Once it moves up to this level here, we're trailing up to this. So all the time we're locking in profits, and at this stage we're locked in profit on 1, 2 positions and a break even on our third. So there's an example. Hope you don't mind. Those of you who don't trade, share, see if these just make any difference what you're looking at. We can look at the FTSE if you want. We just see what the FTSE is doing actually with that positive data coming out. Okay, so if we're interested in the FTSE, let's look at an hourly chart on the FTSE. Ooh, of course, we're going to struggle because this is going to go to. Okay, so let's take this right. But so let's say we're interested in trading the index on the FTSE. So we may get into it here with a stop at under the 20 EMA. We may accumulate into this if it breaks that level there. And then we're going to have to go to the weekly chart and say, well, look, okay, the next accumulation point, it might be there, and so on and so forth. So we can pre-plan all these. So it's not as though you're going in, if you intend to accumulate from the get-go, you can pre-plan on this. Now, the other option is something, is perhaps, there's a US yen going again, is perhaps fractals. Okay, so for those of you less familiar with fractals, essentially fractals mark pivot highs. And this may be something I know Alison does. I know a couple of you guys have looked at this, but accumulation point could be if it breaks a fractal or the previous fractal high since entry. So let's say we entered, we've got a breakout trade on this one here. I'm quite happy with that. Okay, now at this point here, so we could see the previous high fractal on this chart. In fact, these two have matched up quite nicely, so we'll just stick a line there. Okay, so we could accumulate further into here, and we would move our stop up to here. This point here we could accumulate again. This point here we could accumulate again. And at this point, once it's broken that, we could use that fractal there as the trail stop. So that's one way to do it. That's another way to do it in terms of a signal. Mine goes out long on the break of a bearish fractal. Good call. So if you've got a bearish fractal, what that means is if you've got a fractal which is lower than the last one and then you get it breaking higher than the previous high fractal, then that's potentially an entry there. I think that's what you do, Alison, is it? Cool. Okay, so that's one type of signal. Another type of signal obviously could be just trend continuation after a pause. So that's that retracement model. Again, it requires you to sort of say, well, look, if there's a trend pause, you look at where your pivot high is, which again could be determined to some degree by fractals, and you say once it's broken that, from a price point of view, then we're in, or simply ATR levels. So we can sort of say, and this is obviously what the turtles did. So we could say, well, look, let's look at GB pound yen. Let's look at it on an hourly chart. Actually, let's not. Let's forget all those other entries. Let's say we're looking at it because we had a fairly key pullback there, but we've got a nice resistance line kicking there. So we could say, well, look, let's enter on that. But at that stage, our ATR is 13 pips. Okay. So if we were to say, well, look, it's going to be a pip and a half, it's going to be 20 pips down from that. 20 pips down from that line, or 20 pips down from our entry price, whichever you prefer. So in that case, let's say it would be 152.91 would be our stop. Then we might accumulate some more on this move, on that one, certainly on that one, with it being at the top of the candle. So we accumulate here. Now we've got a choice. We can either use that. Oh, sorry, we're doing ATR levels. So if our ATR level is, I'm not sure how fractals have worked out, Ross. I don't think so. I think it's purely on pivot highs and pivot lows. So if we work out our ATR level, so we said it was 20 pips. Bang smack on there, okay? And let's just change this to green so we can identify where our entry is. So what we've got there is a 20 pip gap between here and here, okay? You're not going to quibble between, there we go. So 20 pips, okay? So that's one ATR, oh, sorry, that's 1.5 ATR. So what we could say, what the turtles did is half an ATR, but that was very aggressive. But if we did one ATR, that would be 13 pips. Okay, so that'll be there. That'll be there. And the next one would be at 152.50, so somewhere up here. Okay. And so every time it broke one of these ATR levels, you would be accumulating. They did it on half an ATR, remember, not one ATR. but as I said, that's quite aggressive and maybe work on a daily chart or on a futures chart, but that wouldn't feel quite right for me. So anyway, so we'd be in here and would be accumulated already here and would accumulate it again here with this model, and would use the ATR as a stop going up. So there's our original stop. Then we'd stop to break even. Then we stopped at ATR 1 and stopped at ATR just below ATR 2. So now in this position, we've locked in profit on that one, and on this one, so sorry, on our first one, on this one, where our stop is now here. Now it's touched that ATR. So our risk is essentially, let's say 17 pips or 20 pips from that high there, okay? And that's relatively easy to program because essentially you're programming on a stop move on pips. So you take your ATR, whatever multiple it is, and you say, right, okay, every time it moves up this much, then automatically it's going to move the stop up by this much. Okay, so from a programmable point of view, it's actually not bad. Yeah, it's a 5-bar bracket. Thanks, Alison. Yeah, so just to explain, let's just put fractals on here. So you've got to look at 5 candles to create a fractal. So let's just drag it on and I'll show you. Actually, can I drag it onto another chart because this is getting very messy. Yeah, let's do it on this one. Let's get rid of the trade levels. Okay, so if we look here, stick some fractals on this. So this is a 4-hourly chart. Let's get it a bit closer so you can see in a bit more detail. Let's put on candles. So you'll see this low one here. What we've got to have to create a low is a pivot low with the previous 2 candles being higher and the next 2 being higher as well. So this has got to be the low. With the high, it looks at the previous 2 candles. It's got to be higher than those and higher than the next 2. So if we look at this one here, then we've not actually got 2 higher candles going on. Oh, where's it have? Not sure why it's not created one there. So it looks at essentially 5 bars, and some people like this to identify support and resistance. They see a line of fractals such as that, and there you go. The only disadvantage with that is, I wonder whether you can change it, whether you can, let's just, yeah, the only disadvantage with fractals as I can see is I like close price as a decision-making price. So rather than pivot high or pivot low. In terms of identifying support and resistance lines, because quite often we get wicks above a resistance before it actually breaks through. Yeah, so that's given that's a good point. So that is still forming. So even though this fractal looks at these 2 that are above this low and these 2 previous that are above this low as well, this may change. That fractal may disappear if that candle doesn't do what if it sort of closes below here, that fractal will disappear. All good. Right, so what else? And then you've got to make a decision as to whether other factors involved, such as things like candle close in the top third, things like increased volume from the previous bar. So all these other things you take into account. So what backs up the strength of that signal? When are you going to do a bar close at any time? Obviously, if you're programming this in, then you tend to do an any time. And then, of course, which time frames are you going to use on which instruments? I wouldn't do this. I wouldn't do this on a share. I wouldn't accumulate on a share CFD position outside a daily chart because the markets are open for such a small period of time and there can be such a big walloping gap. So I wouldn't trade an hourly chart on a share CFD, for example, to do this. I might intraday, I guess, after first entry, but very, very unlikely. So it fits to do it on a daily chart on a share CFD. with a daily, with an FX or an index, I would say a minimum of an hourly chart, and there's a reason for that, which I'll talk about in a moment. Your trail stop positioning, you could use your original risk level for accumulation, which would be an ATR or just a number of pips that say this is a potential technical change. And then you've got maybe half an ATR below the accumulation point. Oh, sorry, I didn't mention, just a sub question, if you're going to use ATR levels, quite commonly when I've seen ATR levels used, they work on that original volatility. But of course, if we're trading, let's go to an hourly GB pound Japanese yen. Forget the lines for a moment, but you can see how the volatility fluctuates. So should you be using ATR here? Let's say we're entering on this candle when the ATR was here at 22. Should we be using that all of the time, or reflecting the changes in volatility once it's dropped to here? So is it current ATR, or is it that original ATR that we used? Logic would say if you can come up with a system that takes into account current market volatility, it might be better. But I've no evidence on which to base that, but logically it seems to make sense. So just some of the things to consider when you're putting your system together. And then how many? So the standard would be that you would accumulate, as I said right at the beginning, with a simple system or a simpler system, you would accumulate no more than, you'd have your maximum accumulation, but you'd use your initial as a maximum you're going to enter on each accumulation. So if it's 0.5 mini lots or 1,000 shares, then that's what it would be. Or it'd be no more than that on every accumulation point. The only variation, maybe you may drop it. Okay, but Nigel Hawkes, who some of you know, he had as part of his software something called the odds indicator, which specified a different level of accumulation depending on the strength of the signal. Now, this correlates to some degree with what we're talking about when we looked at position sizing. And just have a quick look. I hear you, Ross. Remember when we talked about position size, and we talked about, well, what you could do, obviously at a basic level, what you're doing is you're saying, right, I'm going to risk more, I'm going to risk X% of my account on any trade. So let's say 1%. But then the next level on from that is to make a judgment on market conditions and then adjust your position side accordingly. So if the market, if there's a lot of risk in the market, like there would be tonight, then you would say, well, look, the market's really uncertain. There's some significant data coming out tonight. The futures have done nothing all day. There's no evidence that it's really looking hugely positive. Therefore, I'm going to enter half a position size. Okay. If it's normal, there's not a massive amount of big data coming out, etc., then your position size normal. If it's really strong, no significant data, really strong technical signals, markets in an uptrend, not trading sideways, then you might say, well, look, I'm going to do 2% on this trade. So you can adjust position size at an advanced level with your initial trade. Now, you could adopt the same approach to your accumulation strategy. So your accumulation level is based, or the number of, or the size of position is based on the strength of signal. And of course, within that, you can include the option to skip. So if you sort of say, well, look, it has like crawled its way over a key price point, for example, you can just say, look, it could be getting toppy, signal line on the MACD is looking a bit tricky. So what we'll do is we'll just skip this as an accumulation and just trail our stop. Okay, so let me just give you a couple of things Now I said an hourly chart. One of the reasons I said an hourly chart is because of this. So if let's say we were trading an hourly chart and we were in this position, we'd accumulated into this position on an hourly chart and we're just stuck here. We're stuck here with a stop at this point. So there's two things that might say, hey, look, we could be in if it broke through this next level, you've got to make a judgment on what does that mean. Well, if it breaks the next level, then it means, well, look, there's some upside potential. But it's definitely going to be, there's that top line. It's definitely going to be a break on the 4 hourly. Okay, so if it does break that level, then that's quite a strong signal. You've got correlation with what's happening in the 4 hourly, whereas if we look at the daily, you got no correlation at all at this stage with that second one. So you actually, no, you do, but not a lot. So you could say, well, look, that signal is a medium strength, therefore I'm happy to go up to 2 times my initial accumulation. However, if you go down, you should never go down. But I wanted just to put this on the chart now. So if you were in this on an hourly chart, you saw this on a 15-minute chart, it would add extra weight, add extra evidence that this could be it. Okay, so if you're wanting extra strength, if you're wanting confirmation of extra strength, you can go up time frames, not usually down time frames. Okay, and then of course you can look at other things like you can look at things like the if we go back to the hourly chart, you can see really that momentum is dropping off. If it does break through, if those lines start to increase again, suggesting an increased momentum, an increased difference between the two moving averages that you've got on there, that's another sign that it could be a fairly strong signal. If that's significant, then you might choose to enter more. But again, you need to define what significant is for you. So yeah, the ATR is essentially takes the last 14 candles and looks at what the average is. So that's really what the ATR does. So that should serve purpose. Okay. Oh, you're welcome, Peter. So those are the things. That's a little checklist for you to consider if you're looking at the next stage on. And of course, if you're converting this into some sort of converting this into some sort of a yay, there might be some things there that might be useful. Okay, now I did promise to talk about reduction. Now, reduction isn't something that I tend to do at all, and so it's sort of difficult to justify it from a personal point of view. But I know that it's commonly used. The magnetic guys use it and use it very well, in that they'll take off if a trade goes in the direction that they choose, like they may have done with that ASX end of quarter trade today. Then what they'll do is they'll take half of the position off to cover the risk level, which means that essentially it's a no-lose trade. If you just take your start point as your no-lose point, okay, so that's okay. So I've never had any success taking partial positions off, but that's personal. So I'm not deriding it. It's something that works for some people and doesn't for others. But in the same way that one can use the longer, if you were in an accumulating position, you thought, right, maybe the time is right to take some of this off the table, then in the same way that you can use your longer time frames to indicate a strengthening signal, you could potentially use shorter time frames to say that that signal is weakening. So if your hourly is your primary time frame, then instead of the pause on the 15-minute time frame, then you could reduce. So let's say you're already up to your, let's say we've been in it from down here, and we'd have just accumulated, continue to accumulate into this position, and at this stage we're at, say, 1.5 standard lots, and it's looking a little shaky. It looks as though it's paused quite significantly. We've not got any signal that it's a sell. we've got the signal line, which is looking towards the top of that. So what we could do is we could say, right, we're just going to check in on the 15-minute chart. And if the 15-minute chart has a reason to get in, or sorry, a reason to get out, then we could potentially reduce it by 0.5, a 0.5 of a lot, or 5 mini lots, and therefore our position, we've reduced our position, we've locked in profit on one of the 3 positions that we've opened, and we're good to go. So that's something else to consider if you like the idea of reduction, in terms of what are you going to use to justify a reduction from an accumulating position. It would be amiss of me not to cover that, but looking at that 15-minute chart, there'll be no evidence to say this is out. There might have been some evidence here, but now if you're still in this right now, really the signal line has caught up, if you like, with the moving averages. So this could have been a signal to reduce if you looked at it at this point, but obviously that was a little time ago. It was sort of up here a little bit. So I hope that sort of makes sense. But as I said, it's not something that I've done or really would fit with me and my individual trading style. So, but it's something to consider perhaps. Again, if you're accumulating lots of positions, say for example within an EA, it might be a good way to lock in some profit to say, well, look, if there's X signal on a particular, let's say you're trading a 15-minute chart on your EA, you may use your 5-minute chart to pull something off the table, just as an example. Sometimes the longer an FX pair flatlines, the bigger the breakout when it comes. Absolutely right, Alison. So this is saying we don't know, and the more it says we don't know, and then there's a change, sometimes that's a big breakout. Sometimes it really is one of those big moves. And that's certainly what I've found as well. So I hear you on that. It's a good point. Okay, so well, look, guys, that really is what I wanted to put across. So what we've done today is so let's have a look at the markets. We've looked at a basic accumulation strategy and what you need to have in place to make that happen. So certainly give that a go. Perhaps test it out, maybe on some of the trades that you've got records on already, and see what would have happened if you're accumulated. Particularly those that have done a runner. Remember, because you're trailing the stop, then your risk is really on that last position that you've entered. Steve, you can drop me a line anyway. Just if any of you want to connect with me. Oh, let me try and type that. Oh dear me. Thanks, man. Markets.com. Right. Always good to get feedback, and always feel free to ask questions. I've put my email address in chat there. Just have a quick look through. Yeah, drop me a line, Chris, if you want that. Thanks, Stuart. Really appreciate it. Presently enjoying TradeView, but Go Markets has no presence to trade directly on the TradeView platform. I'm not sure. G, what I would do is flick an email to support at GoMarkets.com. I'm not sure how the logistics of that work to be able to advise you with which platform do I recommend. Look, you can do this on MT4, MT5. Be really interested. Oh yes, absolutely, via your journal, mate. Yeah, absolutely. You're welcome, Adrian. Cheers, Chris. I'd be really interested to see how you get on with this if you haven't a look at it. Yeah, give it a go. I'd be really interested, Alison, to see what you find out. You're welcome, David. Thanks, Ewan. Great to have you along. Welcome, Steve. Great to see you, mate. Thanks, Alyssa. Cheers, Ian. Glad it's giving you some things to think about. Did I record this? I did, Joe. If you want a link to the recording so you can replay it and just get a better handle on it, then just drop me an email again. Rachel, always welcome. Good stuff, Wayne. Okay, guys. Well, look, the actions of course, I've already said, consider standard accumulation system. Could it work for you? Test it out. Give it a go. If you're already at that place, then of course you can start to look at the next level stuff that we talked about there. As I said, I've given this some significant thought, just again to give you something that's different, something that you won't get anywhere else, because that's what I do. So all that remains to be seen is that I look forward to. Oh, if you're not, not forgetting, if you're not part of this, hang on a second. If you are available tomorrow lunchtime, and you're not part of the live update sessions that happen, you're always welcome. We just look really at what's happening in markets live, suggest a few trades of the day that are worth having a look at. So I'll pop that in chat, the link to that. So just have a look in chat now. If you're not registered for that, get on board. Futures are still flat as Nasdaq started to move, interestingly. Now let's just have a look at an NDX chart just because we can. There we go. There we go. So the NDX is looking pretty interesting. So again, so this is a triangle I painted on this morning. I felt it was in a symmetrical triangle on the daily chart. You can see there why. So we might be just starting to push above that, but just keep an eye on that. That's a nice candle. Just taking that back. Okay, I've got a couple of points here, so you may well say, well, look, if it breaks this, that could be an initial trade. That'll be confirmed breakout. If it breaks that, then I might accumulate in at this point here. Nice technical landmarks. All good. Okay, guys. Well, look, have a wonderful Easter. It's been a pleasure and a privilege, as always, to get this time with you. Thanks for your participation. Walter, you're welcome. Yes, I do save these webinars. Okay, what does the accumulation distribution indicator show? You're welcome, David. It's not one that I use very often, but it sort of it looks at price action and volume, and so that's my sort of understanding of it. I'm trying to remember. It's within. There's a technical analyst, I think, called Matt Chalking. I think that's his name. Who originally developed. Let's just see if we can find it. So it looks at price action and it looks. There we go. So it's really to do with price action and volume. So the idea is that if you see this rising, there's lots of work done by a guy called Wyckoff, who used something called volume spread analysis to make decisions. So looked at price action and volume and how the two relate. You can see how this goes up as the underlying share goes up, and this really reflects the move up and in relation to volume. So what we want to see is it continue to move up and some volume attached. So it's showing something different, but there's nothing wrong with trying a few of these other indicators out to to see if they can be used in this in order of strength of trend, perhaps. You're welcome, Andrew. We've got a robot webinar saved that I could access. Drop me a line in terms of what you want there, David, and I'll see what I can do. So you guys have a great Easter. We've spent quite a lot of time on this today, so I hope it's been useful. We'll catch you again very soon. Take care, trade safe, and remember, this next couple of days could be a doozy, so just be careful. Okay, guys, catch you later. Take care. Bye-bye.